Today, I'm helping you translate the cryptic and occasionally unfathomable terminology that makes owning stocks so darn difficult. I'm giving you the phrase book to navigate your way through the world of investing. Let's say the Michelin Guide to Fine Stock Diving. Consider it the televised encyclopedia Cramerica for tearing back the cloak of mystery that can make managing your own money seem like such an impossible task. The process of picking stocks shouldn't seem as difficult as, say, conducting triple bypass heart surgery of yourself. You shouldn't have to be Stephen Hawking or Albert Einstein to understand this stuff, although with a lot of the pros talk about stocks, I bet even Einstein would have a tough time figuring out what the heck they were saying. Now, I just explained the difference between cyclical companies, think industrial smokestack businesses that need a healthy economy in order to grow their earnings, versus secular growth names, think toothpaste, cornflakes, that consistently expand at about the same pace regardless of where we are in the business cycle. You want to lighten up on your cyclical holdings and double down on the secular growth names when the economy starts to slow. Then do the reverse when it picks up steam. This is the playbook that all the hedge funds use. And even though hedge funds can often behave like herd animals, wildebeests who all buy and sell the same stocks at the same time, their playbook still works. And I don't want you to be trading on and out, and it's okay to buy and do homework, but at least you need you to understand why we have these rotations, what they mean. Now, the reason for this has to do with another piece of Wall Street gibberish lexicon that you absolutely must know if you're going to pick your own stocks. This is something I taught when I worked at Goldman Sachs. It's called the price-to-earnings multiple, also known as the PE multiple, or just the multiple. They all refer to the same thing. And it's the cornerstone of how we value stocks and compare them against each other. Whenever you hear talking heads pontificate about how some stock has become overvalued or undervalued, well, they're really talking about the price-earnings multiple. When you hear someone say that Pepsi is more expensive than Coke, they don't mean that Coke is cheap when it could be trading in, say, the 50s, while Pepsi is pricey when it's trading in, say, let's call it the 130s. The share price tells you nothing about a stock's valuation vis-a-vis another stock. To make any kind of apples-to-apples comparison, you have to take a step back and look at the multiple. And I know this isn't easy. I know that my mom always got confused when I was at Goldman. She always tried to figure out whether one stock was more expensive than the other based on the dollar amount, and that was not right. You see, you got to think about it like this. When you buy a stock, you're actually paying for a small piece of a company's future earnings stream. So to value a stock, you have to look at where it's trading relative to the earnings per share, EPS, which you'll often see rendered as the EPS line. And that's what the multiple lets you do. Okay, so here's the basic algebra. It's not even math. It's something any fourth grader could manage. The share price, letter P, equals the earnings per share. E times the multiple M. The multiple tells you how much investors are willing to pay for a company's earnings. It's the most basic form of valuation analysis. A stock that sells for 20 times earnings is cheaper than a stock that sells for 25 times earnings. Or to put it another way, the multiple is the special sauce of valuation. The main ingredient in that sauce, growth. How much bigger the earnings will be next year than this year, and the year after that, and the year after that, and so on. The stocks of companies with faster growth tend to get rewarded with higher price earnings multiples. Why? Remember, the multiple is all about what we're willing to pay for future earnings. And the more rapidly a business grows, the bigger its earnings will be a few years down the road. So let's just take one. Let's take a fast grower like Chipotle, okay? Let's say it's trading at more than 40 times earnings. Now, that doesn't necessarily make it more expensive than a slow but steady grower like a PepsiCo if it's trading at something like 22 times earnings, because that's not relative. You have to make it relative. Chipotle deserves the bigger price earnings multiple because it has a much, much higher growth rate. Now, here's where it really does get interesting. Multiples aren't static. In different markets, people will pay more or less for the same amount of earnings. When they pay more, we call that multiple expansion. And when they pay less, it's called multiple contraction. Two more items that sound much more complicated than they really are. That's what hedge funds are trying to gain when they play a sector rotation. Of course, the earnings aren't static either. When you buy a stock, you're either making a bet that the E or the M part of the price equation is headed higher. So what goes into the earnings? How do you make sure that they're increasing and they aren't about to collapse? Okay, here's some more vocabulary. When you hear people talking about a company's bottom line or profits or net income, they all mean the same thing, earnings. We call it the bottom line because the number is the bottom figure on a company's income statement. To figure out how quickly a company's earnings could grow in the future, you have to look for clues when it reports its quarterly results. That's why I'm always telling you to listen to those darn conference calls. Finding clues means you're looking at the top line. Another unnecessary piece of Wall Street gibberish is totally interchangeable with revenues or sales again. They all mean the same thing. I'm sorry, it's so confusing. You want to see strong revenue growth, which tells you there's demand for a company's product? This is ultimately the key to sustainable long-term earnings growth. And that's why it's especially important for younger, smaller companies to have fast-growing revenues. Oh, and investors will really pay up for accelerating revenue growth. We make a little joke called ARG, A-R-G, accelerating revenue growth, which means the sales are rising at a faster and faster rate. With a more mature company, it should be able to turn its revenues into profits by cutting costs and then return those profits to you, the shareholder, in the form of a dividend or buyback or both. What else? It's also crucial to consider something that I find most important when I'm analyzing stocks for you on this show, which is called the gross margin. It's in no way disgusting and not the least bit margin. The gross margin tells you what percentage of every dollar of sales a company hangs on to after accounting for its cost of goods sold. It's super important to figure out how much money a company can really make. To get a sense of where the gross margin might be headed, you have to consider the competition, the cost of production, the cost of doing business in general. Businesses with cutthroat competition like the supermarkets or the airlines, well, these tend to have really terrible margins because these guys are always shooting at each other. While a company with little competition, let's use Microsoft, has margins that some people think are downright obese. Some industries, the margins can vary widely. The oil business, where the margins swing up and down with the price of crude. So here's the bottom line. You need to know the vocabulary before you can evaluate a stock. When you're comparing, look at the price to earnings multiple, the PE multiple, the growth rate, the top line, the bottom line, and the gross margin when you're trying to figure out which stocks are worth owning and which stocks are worth sell. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.